Hey everyone, welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's very best macro minds. I'm your host today, JD Durkin. We are with you today to discuss the health of the job market overall as part of the U.S. economy and how investors should view the idea of a recession. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews to help you keep up to date with the latest investment news. Today, we are joined by Andreas Steno Larsen, the CEO of Steno Research. Andreas, good morning. Thanks for taking the time to join us.
It's a pleasure, JD. Thanks for inviting me.
Of course, really nice to have you. So let's talk about this jobs data for the month of August, shall we? A bit of mixed results when you take into account all of the data points we got in the last few days. A miss on job openings. We had that JOLT survey a few days ago. Similar story for ADP. We did have a beat, 187 versus 170 for job additions from the Bureau of Labor Statistics. Break down all of these data points here, my friend, taken together, and how do you currently see the job market as a result?
So in my view, we are edging towards a payrolls recession. The service sector is now clearly weakening on a month-on-month basis. It is evident in all of the most important sectors in services, everything from leisure to hospitality to healthcare, etc. We're edging towards a weaker sentiment and a weaker job market in all of those sectors. But the interesting thing is that we are at a juncture where the manufacturing sector actually rebounds while services decline. And that is kind of an odd cocktail if you look at it historically, because we've frankly never seen such a cocktail before, at least not since the say the modern era of financial policies, etc. So if we look at it right now, services are declining, manufacturing is rebounding, and that may lead the US economy into a so-called payrolls recession, but I'm not sure that it necessarily means that markets will care too much about it if the cyclical component, everything related to the production of goods, actually rebounds from here.
Andreas, are you of the thinking that it sounds as if maybe you're in the camp of what we're experiencing as a bit of a rolling recession? Goods got hit, services got hit. There's concern now about payrolls, as you're citing. There's a lot of concern about things like commercial real estate. As soon as we start to see previously impacted sectors now start to rebound. Is that a fair assessment? Are we in what some would call a rolling recession, you think?
Yeah, I think it's a fair assessment. I mean, if you look at it, tech was obviously in a recession late last year into the early parts of this year. Manufacturing has been in a recession since, well, November, December last year and until recently. And now manufacturing is actually rebounding. But the broad part of the US economy, everything related to services, is now edging towards that recession. And that is where you get the quote unquote actual recession in the US economy. But the question is whether it matters a whole lot for us as investors, because if you look at it empirically, the manufacturing sector and everything that is cyclical, everything that moves from peaks to troughs with a short time span, those parts of the economy tend to drive the financial markets much more than the stickier parts in the service economy. So yes, I think we have a payrolls recession coming up, but I'm still positive. And that's a weird cocktail because I've frankly never seen anything like it in my professional career.
A weird cocktail is how many people have described exactly what's going on between consumer spending, the tight labor market, taking into account all of these weird anomalous things happening at once. One of the other pieces of data we got today, of course, as we get the first Friday of every month, unemployment. It went from 3.5 to 3.8%. A lot of investors out there, Andreas, view the unemployment rate actually as really the key metric when you try and go about the difficult job of evaluating a job market in good faith. Is this a good indicator? You think that the tight labor market is showing signs of easing? And what do you make of the figure going up to 3.8?
So if we try to dissect the labor market as of today, we received the news that the private labor market added 180K jobs roughly in August. That's more than sufficient to keep the unemployment rate steady. So if we look at the details here, the participation rate increased by 0.2 percentage points on the month. That basically means that more people will be unemployed simply as a consequence of them joining the labor market over the course of the month. Secondly, we had a big layoff within transportation and warehousing, accounting for 37K jobs of losses throughout the month of August. So My point here is that, well, yes, unemployment is a decent indicator, but it's lacking. And the move from 3.5 to 3.8% in the unemployment rate is not necessarily something you should care about. What you should care about is whether we get a move from 3.8 to 5. And I think that's likely. But in case of such a move in the unemployment rate from 3.8 to 5, what you need to consider is that you should not invest in sectors with what I call a heavy tilt towards labor markets. The best example I can give you is Walmart, right? If there's a clear hike in unemployment ahead or a spike in unemployment ahead, it means that basic goods will suffer. It means that Walmart, given current wage trends, will still suffer on the cost side as well. So I'm invested personally in everything related to the manufacturing cycle, since manufacturing actually hires. And we see a slowing of input costs in the manufacturing sector relative to everything that's related to the labor market to a larger extent.
I want to take a closer look at the non-farm payrolls, the top headline print we got earlier today. The report provides a lot of valuable information related to industry and sector job additions. You were referring there a moment ago to certain sectors over others. Any areas of the economy you think in which you're seeing particular types of weaknesses or strengths, specifically based on the month of August release we got today?
So if we look at the month-on-month developments here, I'd like to highlight the energy sector. I tend to look at the Challenger Job Survey on a month-on-month basis as well as a great gauge of whether there's a wave of layoffs or not. And in energy, we've actually seen net an addition of workforce throughout the month of August. If we look at the Challenger survey, if we look at the non-farm payroll survey, everything related to transportation is a no-go. We had a big layoff wave in transportation warehousing as a consequence of one large company failing over the course of the month. But overall, if you look at it, the most important conclusion here is that everything related to services decline and everything related to goods production, energy, etc., the good old boomer part of the economy improves from here. And that is why I've tilted everything I do in investment terms towards a cyclical upswing in the US economy. So oil, natural gas, everything related to that, everything related to goods production, those are the sectors to look for because we actually have a quote unquote positive development on the month relative to everything related to services sectors with a large cost base in labor markets.
Andreas, even though we were expecting lighter volume as we head into a 3-day holiday weekend, even though we know historically August and September not exactly the strongest performing months for equities, all that aside, we still had a pretty strong week for both the Dow and the NASDAQ, and I'm curious why you think markets did react the way they did over the course of the last few days.
So let me put it like this. Given the interest rate volatility that we've seen since 2021, everything that just sounds or looks like a pause from the Federal Reserve is positive from here. The reason is that if you look at an investment case in equity space through the lens of interest rates, you basically like the scenario where the Federal Reserve move towards an interest rate environment of less volatility. And that is growing increasingly likely from a probability weighted standpoint. I mean, I've spoken to several members of the committee over the past weeks here, and I get the feeling that they're moving towards that pause. And the reason is that the job market is now seeing declines that could ultimately defend such a view. We've had inflation numbers pointing in the direction of a pause for at least 2-3 months, in my view, but the labor market has not followed suit until today.
Is there anything you think investors are potentially getting wrong at this moment? And that could be with a look ahead to the remaining 3 Fed meetings between now and the end of the year, or anything else on your radar you think maybe people aren't quite paying enough attention to this? What would that thing be?
So let me put it like this. If we look at the yield curve right now, there's a big consensus around a cutting cycle commencing already early in 2024. And ultimately, the cutting cycle will be of volume by New Year's 2024. I think that is wrong. And the reason why I think that is wrong is that we see the early signs of green shoots within energy. Look at the price action in oil today, for example. It's just a great example of everything related to the cyclical part of the economy. There's still a very, very contained supply of natural resources, and there's a demand pickup in everything related to goods production. That is inflationary, and it typically spills over to expectations in the yield curve of higher inflation ahead. It spills over to expectations of a higher sort of natural level of interest rates over time. So that is my big concern right now, that everyone seems to be focused on the cutting cycle commencing in 2024, while oil markets and everything related to energy does not play ball with that view.
Andreas, what's your base case for a recession right now?
My base case is Q1 next year. But the point here is that if we get a payroll recession, which I find very likely for next year, by the way, the recession is not a consensus anymore. Look at Bloomberg consensus for Q1 next year. Look at Bloomberg consensus for Q2 next year, all in positive territory. And that's a game changer relative to everything we've experienced this year. Why do I think that Q1 is a decent assessment right now of that exact timing of the actual recession? Well, we still have 1.5 jobs per unemployed in the US economy. Even if we had that great slide in job openings this week, they still by far exceed the amount of unemployed people in the US economy. So we need further destruction of job openings before we get to the actual recession. The recession commences when we're below 1 on that ratio. That's a pretty decent indicator over time, and we're still far from it. But we're moving fast at this juncture, meaning that on a month-on-month basis, we're moving closer to the recession much faster than we were in, say, January, February this year. So Q1 next year sounds like a decent timing for the recession, but in my humble opinion, it's basically priced into most of the sectors that are sensitive to economic news. So I still like to buy energy. I still like to buy everything related to materials, industrials, despite this view.
And we did see that JOLTS number come down, I believe, from 9.2 to 8.8 million, which, of course, before 2021, we never really had that figure north of 8 million. COVID disrupted all of that. But to your point, we are kind of trending in one direction. That'll be really important for all market participants to follow very closely, including all of our viewers. Are there particular areas of the economy, Andreas, over others that you expect to weaken sooner rather than later?
Yeah, if you look at leisure and hospitality, also in the non-farms report we received earlier, it's pretty clear that the trend is towards zero now in terms of hiring, in terms of growth. And that's one of the sectors basically behind the economic boom that we've seen over the course of the early summer in the US economy. So everything related to travel, to leisure, to hospitality is a must watch from here in terms of negative developments.
I know you've talked about some of the areas where maybe you're more bullish. Any other areas of the economy you expect to show strength that could be for the remainder of Q3, Q4, or early into 2024, I wonder?
The interesting thing is that technology is actually not that reliant on the labor market being in a sound health. If we look at the tech sector, it basically went through a recession from late last year and into early parts of this year. And wage growth has come down in that sector, which is important for that sector. And ultimately, we're also approaching that point where the Federal Reserve considers pausing, right? And there's no sector on earth praying and hoping for a pause more than the tech sector. So I actually think that we will get the odd cocktail of performance in technology and performance in energy at the same time. So I'm trying to be a millennial and a boomer at the same time from an investment perspective here.
Hey, that's allowed. Are you in the camp of a soft landing, hard landing, no landing? Insert option D here. Do you have a new phrase for a type of landing that you're following, I wonder?
Forget about the no landing. I mean, it's a term invented by economists being wrong all year. So we're stuck between the option of a soft landing and a hard landing. And I'm leaning towards the soft landing right now since we get positive impulses out of the cyclical part of the economy. But I guess we will get a recession Q1, Q2 next year. But it won't resemble anything like the 2008 recession. Not that kind of magnitude because the the structures have simply changed in the US economy. We're entering a recession with a labor market that is still very hot relative to what we've seen earlier. So I'm not that concerned, to be honest, especially not for the US. It's a different discussion if we talk China or Europe.
Yeah, it absolutely is. We know that Fed Chair Jay Powell has reiterated time and time again, Andreas, including at Jackson Hole just a week ago, further rate hikes may be necessary. We're data dependent. I'm not going to get out over my skis. That's essentially what he's communicating to the market. Do you think that's the newer employment data we've gotten is enough to hold off, at least in the short term, further rate hikes? We've got September, November, and December.
So September is definitely a skip on this data. The question is whether they want to move in November without the new projections from the staff, without the new dot plot and all that. So my base case would actually be that they deliver a final hike in December, and that will be it. So I'm leaning towards the hawkish side of market pricing, but not by miles. And obviously, given today's data, I don't think they have a case to move in September. They want to watch a few more data prints before moving.
Yeah, of course. And you bring up a good point about those dot plot projections. Obviously, we do not get that information for all 8 FOMC meetings, but when we do, it can tell us a lot, right? Even if it's anonymous largely, it does give us a sense on where the voting members of the Federal Open Markets Committee see a lot of these key numbers going, and we will get some of that information coming up later on this month. Finally, Andreas, in this entire conversation, it could be markets, it could be the economy, it could be the central bank. Is there anything you think we are not talking enough about that you think we should probably spend a little bit more time focusing on in our final analysis day to day as traders?
Natural gas. That would be my quick response to that question. If we look at natural gas right now, remember what happened 12 months ago, right? It was a mayhem in global natural gas markets as a consequence of the Russian invasion of Ukraine, but also as a consequence of political decisions in Europe. And even though storage and inventory situations look much better than 12 months ago, we're still at a juncture where the global market of natural gas is still much, much smaller than a year ago from a supply perspective. Because in contrast to oil, you cannot redirect flows of natural gas easily. There are no pipelines running from the fields north of Murmansk in Russia to other parts of the globe than Europe, and Europe will not buy that gas. So ultimately, what I'm trying to say here is that we lack natural gas globally. And as soon as we get just the tiny glimpse of a pickup in everything related to heavy industries, and now I'm talking Germany, and now I'm talking Korea, I'm talking China, I'm talking the US. If we get just a small sign of a pickup in that industrial activity, the natural gas bull case is back, and no one's talking about it right now.
I appreciate that. See, that's one of my favorite questions to ask smart individuals like you, because you never know where the answers are going to go. And my hope is always that a viewer or a listener gets maybe introduced to something that person wasn't expecting. So I'm very grateful for that. And that takes us into a really interesting conversation. Folks, this has been Leading Indicator, a source of insight from the world's very best macro minds. My special thanks to today's special guest, Andreas Steno Larsen, the CEO of Steno's Research. Andreas, thanks a lot.
Thank you, JD.